It's an age-old question, or at least it's a question I get very often when I'm trying to tell people about the value of high cash value life insurance and the way that we specially design it. Why should you put your money into a life insurance product that has potentially high expenses instead of just using a savings account? I don't have any of the fees. There's no commissions. All of it's available. Why would I bother? I hope to answer that question specifically in this video. Because this question gets asked frequently, we find ourselves answering it frequently because people just don't know. Case in point, Mark here left a couple of comments. He says, financial education, more like financial misinformation? Stay away from trash value life insurance. Watch Rich on Money YouTube video about whole life insurance scam. First of all, I have no doubt that there are plenty of valid stories about scams around life insurance. Most life insurance, cash value life insurance, it's bad. It's badly designed. It doesn't meet whatever the client is trying to do. It doesn't meet their needs, or at least it doesn't meet them optimally. And because of the normal traditional design that's so expensive, it's not a good place to store your money, at least not in the early years. It can be okay after decades. But the problem is getting to that point. So my response said, oftentimes it's not designed or sold correctly. I suggest you check out how we use special low expense, low commission designs in a balanced portfolio for safety and liquidity to maximize our savings and allow our other investment opportunities to flourish. He responded, cash in a high yield savings account is a much better way to be your own bank. Just think about it. Yeah, just think about it. I mean, it's common sense, right? Just think about it. Well, we're going to do more than think about it. We're going to actually talk about it, and we're going to explore it a little bit. His comment says, no commissions, you break even on day one, no fees, 100% available to borrow, or just take it, no surrender fee, no loss of savings upon death. Entire savings grows even with outstanding loans. Entire savings grows even with outstanding loans. You are the bank, so you set your own interest rate to borrow. Can your whole life policy beat that? In fact, my argument is yes, it can. We'll get into that, though. And then he said, if it's the other investment opportunities that flourish, what do I need a whole life insurance cash value for? I might as well put my money directly into those other investments and skip the insurance premiums. Those are actually really good points and things that we should be able to address if we're planning on overcoming those objections. What would be the reason that you would want to pay money, you would want to pay fees, you would want to pay commissions in order to have access to a cash value life insurance product? Millions of people do this every single year. Millions of people buy cash value life insurance products because they see a value in it, some type of value. And the sad thing is most people are buying the poorly designed ones. What we argue for is the properly designed ones, properly designed, properly funded. Those can be really good alternatives to a savings account or a bond portfolio. Somewhere where we can get a consistent growth. In fact, we can get guaranteed growth. That's at a really good, consistent rate that should beat inflation. In fact, probably historically doubles inflation. Like, that's a really good reason to do it if it satisfies some of the other criteria that would otherwise work good in a savings account, which is access to the cash, low fees, uninterrupted compounding, and in general, just a good supplement to everything else that you're trying to do financially. So does it meet all of those needs? Let's address the first part of his question, which was cash in a high yield savings account is a much better way to be your own bank. Okay, let's take yields in a high yield savings account. Now, we can call it a high yield savings account right now because the interest rate environment is up. But just a few years ago, it was just a savings account. There wasn't really high yields at all. This is from Forbes. You can see the national savings account average since 2009. This is abysmal. There was no high yields for most of this time. You might be able to find an account here and there where maybe somebody had special, but you're not going to hop around to different savings account every single year just to get a little teeny tiny better percentage that could go away at any point. How about prior to that? Here's a picture from study.com. This was in one of their videos where they have the average from 96 to 2010. And while it was better back here, wasn't that good in here. Less than 1% since 2002. Prior to that, We had another 8 years, 6 years, where it was 2.1% or less. Your money's not doing a whole lot there. Now, granted, it's liquid. You didn't have any fees to worry about, so I'll grant you that, but it's not going to grow. Now, you could borrow from it. You could use it as your own bank. In fact, I've talked about this in one of my videos. In fact, I have a very good video called The Comprehensive Guide to Infinite Banking. That video, we'll link it up here in the corner. Check it out. There's all kinds of things you can do infinite banking with, or be your own bank. You got your savings account, you borrow from it, make a plan to pay yourself back. You could pay yourself back 5%, 6%, whatever. Go hog wild. Pay yourself back 10%. Doesn't matter. That is one way, a valid way, that you could be your own bank. The money's going to be in there. Now, it's not very protected. You know, FDIC gives you protection up to, what, $250,000 or $125,000? It's mostly protected. But in a run on a bank, if you got more money in there than that, it could be in trouble. So you probably keep it somewhere else. For the most part, you're probably just going to use a savings account for your emergency fund. Well, let's take a look. When I compare life insurance, why wouldn't we just keep our emergency fund in our life insurance? What would be the appeal to doing that? It doesn't even have to be your own bank. In my mind, there's value in high cash value life insurance as a diversification tool for whatever you're doing with your finances. It could be a place to store your emergency fund. It could be more impactful than that as a place to be your own bank. It works really great for real estate investors in order to be able to just store their cash when it's not being deployed and avoid using private lenders when they need to take on small projects. Really, any business owner could benefit from squirreling away a bunch of cash for a rainy day. Anybody could, whether it's a new investment opportunity, an emergency fund, or whatever. So I think we've established the rates, not very good. How about the recent dividend history from some of our top whole life companies? Since 1989, over 7%. Since 2002, just under 7%. Basically right between 6 and 7 for most of these. Since 2019, just under 6% across the board. Now, where we're at right now, a little over 6% for our top companies. You remember those rates that we saw in the savings account? 2002, 2%, and then it went to an abysmal less than 1% and almost zero. Meanwhile, we have solid dividends throughout this whole time, because when you're part of a mutual whole life company, you're owner of the company. Why would you want to put your money into a savings account when you can actually own part of a company and you get to participate in that company's profits? And these companies are historically wildly successful. In fact, you can see the dividend rates going back a long, long time. Here's through 1959. Not one point was it lower than the 2.1%, which was the high point that we saw between 1996 and 2020. Here's one where we have the historical data all the way back to 1872. Not 1 point was it lower than the 2.1. In fact, it didn't even get close. I think the low point was 3.1, 1952. Your savings account's just not going to beat that. Maybe it beats it this year. Maybe. You're not beating 6% in a high yield savings account this year, but you might get 4% or 5%. Good for you. Where's it going to be next year? How about 10 years from now? Where was it at 5 years ago? You just don't know. But we have a really good expectation inside of a good whole life company's whole life insurance product that we can expect a long-term internal rate of return of between probably 4.5% and 5.5%. And that's in the interest rate environment of a few years ago. That could get better as the interest rate environment improves. So from a rate standpoint, we got it beat. Just because you're not paying a little bit of commissions, you're saving the commissions and you're able to put that money inside your savings account and have it grow, you're not going to touch these rates. What is the rule of 72? The rule of 72, you divide it by whatever interest rate you get, and that tells you how long it takes to double. 72 divided by 2 means it's going to take you 36 years to double your money in that savings account. How about when it was at 1%? 72 years to double the money you put into your savings account. In here, 6%. Let's go with the average since 2019, 5.74. That's about a 12-year timeline to double it. A little bit over 12 years. So if we can double our money 5 times in the 72 years it took you one time to double your money, do you think that might be worth paying a little bit of extra, paying a little bit of commissions? I think it could be. So from a rate standpoint, savings account doesn't even touch it. High yield savings account, You might for a year or two right now in this environment, but not long term. What else do we have here? No commissions. I think we just addressed that. If we can keep the commissions low, this is key. I am not a fan of life insurance products that pay a big commission. If it's a large chunk of what you're paying into it, year after year after year for 10 or 12 years, compared to the value that you're getting out of it, that's really hard to overcome. It doesn't mean that it can't be okay in the long run, but I'm not a fan of it, and I don't advocate for that. What I do advocate for is a low commission design, the ability to put in a large amount of money and have very low expenses so that most of what we put into it turns into cash. Okay, no fees. Yeah, what are you getting for it? Again, if I can double my money in 12 years and it takes you 72, I'll gladly pay the fees. Okay, 100% available to borrow or just take. Now, there's certainly some value in that. Do you need access to 100% of your money all the time? I would argue that you don't. Let's take the savings account as an emergency fund. Let's say you have $50,000 in your emergency fund. Now, I would advocate for you to put that emergency fund into a life insurance product, high cash value, specially designed, so that we have a lot of the cash available right up front. Now, we're not going to take the $50,000 and put it into the account right away. Let's say we're just going to transfer it in over the minimum number of years until we can turn off the premiums. So we're not going to have any ongoing expenses after 7 years. Let's take that $50,000. We're going to move it into a whole life policy over 7 years. $50,000 divided by 7. That means we're going to be putting in a little over $7,000 a year into a whole life policy for 7 years. You don't have to put anything else in there after that. So in the first year, you put $7,000 in there. On our specially designed policies, you should have 80 to 90% cash value available in that first year. So your emergency fund drops from $50,000 down to $43,000. And over in our life insurance, we have cash value of about $6,000. We went from an emergency fund in the savings account of $50,000 that was available to borrow, liquid, there for emergencies, to a total of $49,000. But now we have a life insurance policy. We have a death benefit immediately. In this scenario, let's say the death benefit is $150,000. If you were to die tomorrow, your loved ones with the savings account plan would get the $50,000. If you bought the life insurance policy that I advocate for, they get the $43,000 that was in the savings account, and they get $150,000 out of the life insurance policy. Now, we don't expect to die, and we don't want to die, but that's quite a return on capital. You wouldn't have gotten that anywhere else, and it's tax-free to them. How about year two? Year two, we put another $7,000 into the whole life policy. Now we have $36,000 inside of the savings account. We've put $14,000 into the life insurance. But again, there's some expenses that are going to come out, but they stay about the same each year. So figure about $1,000 in expenses. We got another $6,000 in there. So we now have $12,000 in there. But then we also got a little bit of growth from the first year. So let's say we get $100 of growth. It'll probably be more than that, but let's say we get $100 of growth. So now we have $12,100 cash value in our life insurance and $36,000 in the savings account. Had you just gone with the savings account plan, you got $50,000 still, maybe a little bit more. You get a little bit of growth, but the growth is going to get taxed each year. You're going to get a 1099 on any interest for the growth that you got in the savings account. So let's just assume you got 50,000, maybe 50,100. In my plan, we've got 36,000 still in the savings account, plus the little tiny bit of growth, and we got 12,100 in our life insurance. Total of 48,100. We're just slightly behind what's going on in the savings account. Now, with these designs, we expect to hit a break even of about 5 years with the life insurance policy. So let's fast forward to 5 years. 5 years, we put in $7,000 a year. We put in $35,000. That means we've taken out $35,000 from the savings account. So in the savings account, we still have $15,000. And in the life insurance policy, we've got $35,000. We now have the same amount of money between the two, not accounting for likely a little bit more of growth that we had in the life insurance policy, but we're essentially even after 5 years. We've now transferred all of our emergency fund from a savings account that who knows what it's going to get you on any given year into a life insurance policy that we can expect to get an internal rate of return over the next 30 years of 4.5% to 5.5%. And in today's interest rate environment, we're getting close to 6%. Fast forward 2 more years. We're 7 years into it. We moved all $50,000 into the policy. We no longer have money in the savings account, but we're well past our break even. In fact, by year 7, we're probably pushing 60 grand in there. And it's only going to accelerate every single year how much money is in there. We still have that death benefit, although after year 7, we're going to do what's called a reduced paid up because we're not moving any more money in there. We just moved our emergency fund. When we do the reduced paid up, the death benefit is going to reduce to an amount that's considered fully paid up. No more premiums go in. Because this is a whole life policy, it is going to last until you die. That death benefit was reduced, but from now on, it's still going to continue to kick off dividends. Those dividends will buy more death benefit and turn into cash value every single year. So that death benefit and the cash value are going to continue to grow, guaranteed, every single year until you die. We just transferred that emergency fund over there. We didn't put any more money in there other than that. And now we're in a product that we're going to double our money probably every 12 years or so. And we have a death benefit if we happen to die unexpectedly. And it's liquid. I can access that cash value at 5% at any point. There's no minimum payments due. There's no penalties. There's no taxes. I can access that money tax-free through policy loans. And when I want to, I can pay that loan off. And the money's available to borrow again because it works just like a line of credit, just like I had that money in my savings account. So we just thought about it. What do you think about it? Did our whole life policy beat what you had to offer in the high yield savings account? I would argue that it did. Now, let's look back a little lower. Let's go to the next part of it where it said, if the other investment opportunities that flourish, if it's those investments that flourish, why not just skip the insurance premiums? Okay, presumably you do value your life and you do carry some type of insurance because if you were to die, your family is going to miss out on all of the potential income that you would have been able to bring in throughout the rest of your life. Normally, we value that at like 30 times your income. Depends on how old you are. So if you're going to be paying for insurance anyways, to be properly covered, sure, you could just buy cheap term insurance. That works out well when you're young, but it is a straight expense. When we put money into our life insurance policy, a cash value policy that's specially designed, we're going to have more money in there than we paid into it. How much did the insurance cost us in that case? Didn't really cost us anything. We did other things with that policy, and the insurance just came along for the ride. Sure, it cost us a little bit of money, but we minimized that cost. It doesn't cost very much. And the total package, the benefits we get from that total package, far outweigh what little cost goes to the insurance. Now, because of the special design, our cost in that policy is very similar to the cost of a cheap term policy, because we're going to blend in a bunch of cheap term that doesn't pay anybody a commission. That's how we keep the costs very low inside these things. So it's not a matter of buy term and invest the difference. We are buying term. We're putting a little bit more than that into the permanent part of the policy that we have to get the tax benefits and make it an efficient place to store our wealth. Am I breaking through at all into the line of thinking that might open you up to the possibility that maybe life insurance could be a good place to store your money? Now, the investment options, why not put your money directly into those? That's a good question. It really depends. Sometimes you would just put your money directly into those. There's no reason that you would have to divert it into a life insurance policy first. It depends on how you're trying to use the policy. Where does the policy fit in with the rest of whatever your financial goals are? I like to utilize my policies as a bond alternative, my whole life policies, that is. I also have IULs, which I use as kind of a supplement to what I'm doing in the market. I can get some good growth. I have access essentially to the S&P 500 at a very, very high percentage rate, sometimes capped, sometimes uncapped. It depends on the product. But in the ones that I own personally, I have access to the S&P 500, almost all of the upsides, none of the downsides. Or capped to the upside of the S&P 500, but none of the downsides. Sure, I could just put all my money into the S&P 500, but I don't trust the markets. I don't know what they're going to do. We can see what they've done historically, and we can participate in them expecting that they're going to continue doing that. But I can't tell you in any given year if there's going to be a 50% drop in the value of the S&P 500. That's happened in my lifetime. There was also a 30% drop. And we're right now experiencing a 10% drop. I don't know when it's going to happen. Do I want to take that risk when I get close to retirement? I don't. Do I want to take the risk prior to retirement? Sure. But how much? How much of my portfolio do I want to have at risk to the down market? Well, if I store some money inside my IUL as an alternative to putting all of it in the S&P 500 or whatever stock you choose, but let's follow the simple path to wealth that says invest in a cheap ETF That's all you need to do because hardly anyone beats the market long term. Okay, so rather than having everything in there, if I put a little bit outside of that, now it could be a lot, could be a little. It's up to you. You got to decide how to diversify. Rather than having all of it in the S&P 500 and seeing all of it go down when the market drops, if I have some of it outside of there, then I've been experiencing the gains of the S&P 500 or almost all of the gains on that small amount that I had outside of it. When the S&P drops, I could actually borrow from that part because it doesn't lose any money. It didn't go backwards, but I could borrow from there and buy into the market with it and take advantage of a massive drop because I didn't have all of my funds exposed to the market downturn. There's value in having things that are not correlated to that downturn in the market, whether it's whole life or even in the IUL. Now, in this instance, I'm talking specifically about the IUL and a very similar exposure to what I would be exposed to if I was just in the market. Now, don't get me wrong, I'm a fan of the S&P 500, but there are legitimate risks that you have to be concerned about. And for most people, it's an emotional risk. Most people have a hard time riding out those downturns. Think back 5 years, middle of COVID, the market was just going down day after day, week after week. It lost a ton of value over the course of a few months. Nobody knew when it was going to stop because our economy was at a standstill. At what point does the panic set in? If you're anywhere near retirement, at what point do you get out of that and say, you know what, it's not worth the risk? I don't have time to see if this is going to come back because I've got retirement coming up. Even if you're not in retirement, if you've been stashing a bunch of money into the market and you just see it going down week after week and everything in the country looks horrible because we got lockdowns, people are dying, hospitals are overrun. That was total chaos. Do you have what it takes to continue putting and buying at the low point there? Now, fortunately, for those who did, the market recovered very quickly, unexpectedly quickly. It was not expected to be that quick with the environment that we were in. Most big downturns like that, they don't recover so quickly. Might take a few years. But that emotional roller coaster is very real. That is not something that we have to deal with the money that we're putting in our life insurance. So the value of having a properly designed and funded high cash value life insurance policy can be immeasurable when it comes to acting as a volatility buffer, giving you the peace of mind that you need, that you're going to have access to cash when you need it, able to access it if you have other investment opportunities. You don't have to borrow from it. You can just take your money out of it. You can withdraw it if you want to. So it's not like you have to borrow your own money. I'm going to make one other point because there was a comment that you made right here that said no loss of savings upon death. Now, I'm not sure what you mean there, unless you're talking like Dave Ramsey does, where he says, you don't get the money, you only get the death benefit. You got this cash value that's been building up in there, but they keep it. They keep your money, and they only give you the death benefit. It's just a backwards way of thinking about life insurance, and it's wrong. The cash value in your policy is part of the death benefit. It's always a part of that death benefit. If that cash value wasn't there, the death benefit would be lower. If the cash value wasn't there and the death benefit was the same, your inside costs, your internal costs would be higher because you're paying for the difference between the cash value that's in there and the overall death benefit. Doesn't matter what type of policy you're getting. That's what's at risk to the insurance company, and they're charging you for it. So we want to grow the cash value inside of it. That cash value is available to us before we die, but it's available tax-free to our beneficiaries along with whatever death benefit we're paying for. So if we didn't use the cash personally while we were still alive, it gets passed on as part of that tax-free death benefit to our beneficiaries. So I hope that this worked to clear things up. My name is James Barber. I'm your Oregon Cash Flow Pro and appreciate you guys joining me today. If you want to learn more about this stuff, hit that like button, subscribe to the channel, and stick around. You can always put comments in the comment section. I will try to answer every question that we get. And as always, we're here to try to help you learn more about this stuff so that you can do better in your finances, whichever route you decide to take. So in the comment section, tell me, what makes more sense, savings account or high cash value life insurance? The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.